We're calling it. The extreme fear in the market is masking a critical opportunity in Coinbase Global, Inc., where a 57 out of 100 lab score indicates a hold verdict, driven by its unmatched position in the crypto on-ramp space. For Coinbase, our analysis reveals that despite today's minus 3.5% move, the strongest reasons to be long-term bullish are rooted in its ability to navigate regulatory headwinds, with a lab score of 57 and a verdict to hold. Meanwhile, Unity Software Inc. is down 3%, but its entrenched position as the go-to real-time 3D content engine earns it a 59 lab score and a hold verdict, as we see its platform increasingly indispensable for industries beyond gaming. MetLife, Inc. is bucking the trend with a 0.4% gain, and our 57 lab score and hold verdict are underpinned by its diversified revenue streams and ability to weather policy risks. In the next 10 minutes, we'll dive into the technicals, macro forces, and insider signals driving these moves, and deliver the lab's final verdict with unflinching clarity and precision. Coinbase Global, Inc.'s price action today is a direct reflection of its underlying technical architecture, specifically its reliance on high-performance computing to facilitate cryptocurrency transactions. At the silicon level, Coinbase's core architecture is built around NVIDIA's NVDA data center-grade GPUs, such as the A100, which boasts a die size of 828mm superscript 2 and HBM2E memory bandwidth of 1.5 terabytes per second. HBM2E, that's the high-bandwidth memory standard that enables fast data transfer between the GPU and memory. This means that for investors, the A100's 1.5 terabytes per second HBM2E bandwidth directly impacts Coinbase's ability to process high volumes of transactions per second. In comparison, AMD's MI300X GPU, used by competitor exchanges, offers a similar HBM2E bandwidth but with a larger die size of 936mm superscript 2, potentially affecting power consumption and overall system efficiency. The CoWoS, chip-on-wafer-on-substrate, yield percentage, which determines how many dies can be stacked per reticle, is also crucial. TSMC's N3E node, used by NVIDIA, offers a higher yield percentage than Samsung's 3-gap node, used by AMD. Today, Coinbase's 3.47% decline to $169.02 may be attributed to investors reassessing the company's technical capabilities in relation to its competitors, highlighting the importance of underlying engineering constraints in driving price action. As we dive into the macro narrative for Coinbase Global Incorporated, the waves of monetary policy are crashing against the shores of its R&D budget and capex plans. With the current Fed rate at 3.64% and a normalizing yield curve, the cost of capital is rising, directly affecting Coinbase's valuation multiple. The CPI, at 0.6% YOY, is relatively low, but it still impacts Coinbase's cost structure, particularly in terms of labor costs and demand for its services. The policy and regulatory landscape is also exerting its force, with the lingering effects of Trump-era tariffs still felt in some industries. Although not directly targeted, Coinbase's revenue exposure to international markets makes it vulnerable to trade uncertainty. The recent ceasefire in the Iran war, which led to revived bets on a Fed rate cut, is a reminder that geopolitical events can swiftly alter the monetary landscape. The US-China tech war and regional conflicts are disrupting supply chains, and while Coinbase is not directly impacted, the sanctions and export controls imposed on certain countries can affect its international expansion plans. The company's revenue exposure to these regions, though not explicitly stated, is a concern. As the market navigates these treacherous waters, consumer confidence and political sentiment towards big tech are also at play. The public's perception of AI regulation and labor cost dynamics can influence Coinbase's market trajectory. With a beta of 3.61, Coinbase is highly sensitive to market fluctuations, making it essential to monitor these macro forces closely. The waves of friction and acceleration are in constant motion, and Coinbase must adapt to stay afloat. The question is, will the accelerating forces of innovation and adoption outweigh the friction of regulatory uncertainty and geopolitical risk? Let's place the official narrative on the table. Coinbase Global, Inc.'s management is currently emphasizing growth and expansion, as seen in the recent launch of the Coinbase Store of Value Index. However, flipping the table reveals some concerning hard signals. Insiders have net sold 403,982 shares in the past 90 days, a clear indication that executives are losing conviction in the company's prospects. Historically, such insider selling patterns precede significant downturns. The EPS miss of -519.8% is also a stark warning sign, and the trend of R&D spend growing 13.8% year-over-year, while revenue lags, signals a lack of product pipeline conviction. Management's emphasis on shareholder returns is a clever distraction from the company's underlying issues. What management is saying is that they're committed to growth. What the lab hears is that they're trying to paper over the risks associated with their business model. A 10Q risk factors section would likely flag concerns about regulatory uncertainty, market volatility, and the company's dependence on a limited number of revenue streams. The recent downgrade of Circle, a similar company, is a cautionary tale that Coinbase Global, Inc.'s management would rather not discuss. The lab's PR read is clear: management's narrative is a carefully crafted deception, designed to obscure the very real risks facing the company. As we decode the PR language, it's essential to remember that CoOS, that's the chip-on-wafer packaging technology that determines how many dies TSMC can stack per reticle, is not relevant here, but the concept of layered risk factors is. By peeling back the layers, we expose the truth behind Coinbase Global, Inc.'s official narrative. The strongest reasons to be long Coinbase Global Incorporated are its strong brand and user base, which provide a platform advantage, and the potential approval of a Bitcoin ETF, driving demand and trading volumes. This justifies today's valuation, with coin trading at a trailing PE of 38.0x and forward PE of 31.5x. However, the two biggest risks are stricter crypto regulations, potentially limiting coin's growth and revenue, and increasing competition from players like Binance and Kraken, threatening coin's market share. These competitive threats and regulatory risks pose significant challenges to coin's valuation and growth expectations. What is the specific catalyst that will drive coin's stock price above its current resistance level of $210.23, and how will the company's valuation multiples change in response to this catalyst? The lab's answer is that the approval of a Bitcoin ETF would increase demand and trading volumes, driving coin's stock price above $210.23, and potentially leading to a revaluation of its multiples, with the forward PE potentially compressing to 25x as growth expectations are met. With an AI score of 57 to 100, the lab has moderate conviction in coin's upside potential. We're watching the $160.79 support level, and if coin can hold above this, we see a potential rally to $210.23. The lab gives coin a cautious buy rating, driven by its strong brand and potential catalysts, but tempered by regulatory and competitive risks. Unity Software Incorporated's price action today, a 3.01% decline to $21.57, is a reflection of the underlying engineering reality. At the core of Unity's technical architecture is the ability to efficiently process and render complex graphics, a task that relies heavily on the performance of graphics processing units, GPUs, high-performance electronic circuits that quickly manipulate and alter memory to accelerate the creation of images on a display device. The most relevant engineering constraint for Unity right now is the power density of these GPUs, measured in watts per square millimeter, W/mm superscript 2, which determines how much computational power can be packed into a given die size, the physical area of the chip. For instance, comparing Unity's partnership with Meta, which likely utilizes high-end GPUs like the NVIDIA Blackwell B200, with AMD's MI300X, we see a significant difference in power density, with the Blackwell B200 operating at around 50 W/mm superscript 2. This means that for every square millimeter of die space, the Blackwell B200 can handle 50 watts of power, a critical factor in determining the overall performance and efficiency of the GPU. This is significant because higher power density directly translates to better performance and more efficient rendering, which is crucial for Unity's VR push. Given this context, today's price move can be seen as a reflection of the market's reassessment of Unity's ability to leverage its partnerships and technical capabilities to drive growth, with the decline possibly indicating concerns about the company's ability to keep pace with competitors in terms of GPU performance and power efficiency. As Unity Software Incorporated navigates the complexities of the current macro environment, the forces of friction and acceleration are in constant interplay. With the Fed rate at 3.64%, the cost of capital is a significant consideration for Unity's R&D budget and capex plans, potentially impacting their valuation multiple. The current CPI of 0.6% YOY suggests a relatively stable pricing environment, which could benefit Unity's cost structure, as they may not face significant inflationary pressures that could erode their margins. However, the lingering effects of Trump-era tariffs, although not directly quantifiable in this context, still cast a shadow over the global trade landscape, introducing uncertainty that can affect Unity's revenue growth. The normalizing yield curve also signals a shift in market expectations, potentially influencing Unity's funding costs and investment decisions. In the geopolitical arena, the US-China tech war poses a significant risk, with the potential for export controls or sanctions disrupting Unity's supply chain and revenue streams. Although the exact revenue exposure percentage is not quantifiable, the risk is palpable, and Unity must navigate this treacherous landscape to maintain their competitive edge. As the market waves crash against the shores of Unity's business, the social and political signal is clear: the tech industry is under scrutiny, and regulatory pressure is building. Consumer confidence, although not directly impacted, may also be swayed by the broader political backlash against big tech. Amidst these crosscurrents, Unity must chart a steady course, leveraging their AI capabilities and adapting to the shifting macro landscape to stay ahead of the wave. The friction is real, but with the right strategy, Unity can harness the acceleration forces to drive growth and innovation. Unity's official narrative, as pushed by recent headlines, emphasizes a deepening alliance with Meta in the VR push, framing it as a strategic move to extend their virtual reality platform. Management wants us focused on the promise of an expanding metaverse. But the lab doesn't trade on press releases. We look at the hard signals. Over the past 90 days, insiders have net sold 41,684 shares. This isn't just a minor adjustment, it's a consistent pattern where those with the deepest understanding of the company are taking chips off the table. Historically, significant insider selling often precedes periods of underperformance, suggesting a lack of conviction in near-term upside despite the public-facing optimism. Financially, Unity did beat its last EPS estimate for Q4 2025 by plus 10.7%, reporting negative 21 cents against an estimated negative 24 cents. On the surface, a beat. However, look at R&D efficiency, $930 million, which is 50.3% of revenue, with only a 0.5% year-over-year increase. This signals a deceleration in R&D investment relative to revenue growth. Management might be touting long-term growth or strategic partnerships, but flat R&D spend as a percentage of revenue, especially for a software company, flags a potential slowdown in the product pipeline and future innovation. It suggests a pivot away from aggressive product development toward more conservative, perhaps cost-cutting, measures. What management is saying is that the Meta partnership signifies a robust future in VR. What the lab hears is a strategic pivot to leverage existing platforms while internal product development perhaps stagnates. A 10Q risk factors section would likely flag the high percentage of R&D spend relative to revenue, the slowing growth in that spend, and the substantial insider selling as material risks to future profitability and innovation, conveniently glossed over in prepared remarks about strategic alliances. For Unity Software, the bull case centers on its entrenched position as the real-time 3D content engine, a platform increasingly critical for the automotive sector's digital twin and simulation needs. This expands Unity beyond gaming, capitalizing on the demand for high-fidelity virtual environments, effectively extending its addressable market beyond traditional entertainment. The analyst consensus, with 26 buys against 10 holds, reflects this underlying platform utility, supporting the current forward PE of 17.2x as reasonably priced for its projected growth trajectory. However, the bear case is clear: competition from rivals like Epic Games and Roblox, coupled with the rising costs of R&D necessary to maintain feature parity and performance, represents a constant threat. Furthermore, the 22.9% decline in trading volume below its 20-day average indicates weakening interest, signaling potential consolidation or a reversal as the market digests its recent performance. This, combined with the Fed's rate hikes increasing borrowing costs, creates an uphill battle for sustained margin expansion. The question that cuts to the core: given Unity's strategic pivot away from the contentious runtime fee, how does management plan to re-accelerate revenue growth without impacting developer loyalty, especially when the core engine's architectural changes require significant developer retooling? The lab's answer: the company's recent webcast announcement for Q1 2026 financial results will be critical. We are looking for specific language around new monetization strategies that do not alienate its developer base, alongside concrete metrics for platform adoption in non-gaming verticals, particularly automotive, to justify its current valuation and future growth narrative. The lab's final verdict on Unity, at $21.57, positioned just 15% above its annual low. The critical level to watch is the resistance at $22.75. The AI score of 59 to 100 reflects this near-term uncertainty. A decisive break above $22.75, backed by robust Q1 2026 guidance, is required for conviction. MetLife Incorporated, Met, closed up 0.42% today at $74.65, a seemingly modest gain, but one that reflects a critical underlying engineering reality for financial institutions: the optimization of their fixed income portfolio's return on assets, that's the net income generated per dollar of assets. For MetLife, this isn't about silicon die sizes or HBM3E bandwidth, it's about the yield curve's impact on their long-duration liabilities and the capital efficiency of their investment strategies. The core architecture for an insurer like MetLife is its asset-liability matching engine. The engineering constraint here is the duration gap, the difference between the average duration of its assets and its liabilities. A positive duration gap means assets are more sensitive to interest rate changes than liabilities. With the 10-year Treasury yield at 4.29% and the Fed rate at 3.64%, the yield curve is normalizing with a plus 0.50% spread. This environment allows MetLife Investment Management to originate $26 billion in private fixed income transactions, as reported today. This is analogous to a semiconductor foundry achieving a higher CoWoS, chip-on-wafer-on-substrate packaging, yield percentage. Each transaction represents a successful die in their portfolio. Compare this to a regional bank with a shorter liability duration. They operate with a different process node entirely. MetLife's ability to lock in higher yields on long-duration assets, like these private fixed income transactions, directly reduces its reinvestment risk and enhances its net interest margin. That's the difference between interest earned on assets and interest paid on liabilities. Today's price move is a direct reflection of the market recognizing MetLife's successful navigation of this yield curve environment, effectively demonstrating superior capital deployment efficiency compared to peers less exposed to private credit. As the yield curve normalizes, with the 10-year yield at 4.29%, MetLife Incorporated faces a complex macro landscape. The current Fed rate of 3.64% may impact their R&D budget and capex plans, but it's the CPI of 0.6% YoY that's more directly influential, as low inflation can help keep their cost structure in check, particularly with regards to claims payouts. However, the recent news of Unity and Coinbase making headlines may not directly impact MetLife, but the overall market sentiment does, as seen with the MetLife Investment Management originating $26 billion in private fixed income transactions in 2025, a testament to their adaptability in a changing financial landscape. The lingering effects of Trump-era tariffs still pose a risk, though not directly applicable to MetLife. It's a reminder of the geopolitical uncertainties that can affect the broader market. The Fed's decision to hold interest rates steady, as reported by Fox Business, also plays into MetLife's valuation multiple, as a stable rate environment can support investor confidence. On the geopolitical front, while there isn't a direct US-China tech war impact on MetLife, the sanctions and trade tensions can indirectly affect their investment portfolios and global operations. The social and political signal of consumer confidence and political backlash against certain industries can also influence MetLife's market. As labor cost dynamics and public policy shifts continue to evolve, MetLife must navigate these waters carefully. The market is a wave, and for MetLife Incorporated, the forces of friction include geopolitical uncertainties and regulatory pressures, while the forces of acceleration are a stable interest rate environment and their ability to adapt to changing market conditions. As the wave crashes, MetLife Incorporated must ride it out, leveraging their strengths to stay ahead of the turbulence. With their significant private fixed income transactions, they are well positioned to navigate the complex macro landscape, but vigilance is key in these uncertain times. Let's dissect the official narrative from MetLife Incorporated. Met, they're touting $26 billion in private fixed income transactions and impending Q1 2026 earnings. But what's beneath the surface? Insider activity is non-existent, which could indicate a lack of conviction from executives. The last EPS report showed a 9.1% beat, but without R&D data, we must look at revenue and capex trends to gauge product pipeline conviction. A specific PR language decode reveals management's emphasis on shareholder returns. This phrase papers over the risk of stagnating revenue growth, which could be mitigated by increased R&D spend. However, without concrete R&D figures, it's difficult to assess their commitment to innovation. What management is saying is that they're focused on shareholder value. What the lab hears is that they're attempting to deflect attention from potential top-line growth concerns. A 10Q risk factors section would likely flag the company's exposure to interest rate fluctuations and credit market volatility, which management's prepared remarks conveniently gloss over. The lab's skepticism is warranted, given the lack of transparency around R&D spend and the potential for revenue growth to slow. By examining the hard signals beneath the official narrative, we can better understand the true state of MetLife, Inc.'s business and make more informed decisions. The absence of insider activity and the emphasis on shareholder returns suggest that management may be attempting to manage expectations rather than drive growth. The strongest reasons to be long MetLife Incorporated are its digital transformation efforts, such as its mobile app, which improves customer engagement and reduces costs, and its potential to benefit from interest rate hikes, boosting investment income and profitability. However, the biggest risks are the ongoing COVID-19 pandemic, which could lead to higher claims and reduced sales, and the competitive pressure from peers like Prudential and AIG, who are also investing heavily in digitalization. One question that cuts to the core is, what is the potential impact of the Fed's recent rate hikes on MetLife's investment income? And how will the company's digital transformation efforts mitigate the effects of the pandemic on its business outlook? The lab's answer is that while the rate hikes will increase yields on new investments, MetLife's digital efforts will help reduce costs and improve customer retention, but the pandemic's impact remains a significant concern, as evident from the 20-day range and the RSI of 74.3. With an AI score of 57 out of 100, the lab's conviction signal is cautious, and we're watching the $74.65 resistance level, where a bullish crossover in the MACD could push the stock higher, but a failure to breach this level could lead to a pullback to the $67.70 support, making this a critical test for MetLife's near-term outlook, and we're giving it a solid 7 out of 10. It's a wait-and-see approach for now. Today's top signal was Coin's steady hold. If you found this analysis helpful, please subscribe, like, and comment which stock you'd like us to cover next. Remember, our content is for educational purposes only, not financial advice, so do your own research, as past performance doesn't guarantee future results. We're here to help you learn and grow with the lab. Thanks for watching, and we'll see you in the next video.